Okay, real quick, think about the last time you checked your bank balance. Maybe it was the morning, maybe it was 5 minutes ago. You opened the app, saw a number, and thought, alright, that's my money. It's just sitting there, safe. Here is a question nobody ever asks. Is it actually here? Like physically, if you and every single person and your bank walked in tomorrow morning and saw, I want all my money in cash right now, would the bank hand it ever? The answer is no, not even close. And here, the part that going to bother you, your bank is not just doing anything illegal. In fact, what they're doing is completely protected by law. It's been this way too for over a century. It's taught in every economics class, and almost nobody who actually had a bank account understand it. By the end of this video, you will, and more importantly, you are going to understand what it actually means for your money, your financial decision, and why the people who build real wealth treat bank very differently than the rest of us do.
My name is Nick, and I spend way too much time thinking about how the banking system actually works versus how most people think it works. If you are someone who works hard, saves responsibly, and just assumes your money is sitting in a vault with your name on it, make sure to hit the subscribe button and give this video a thumbs up if this helps you out, because what we're about to get into is one of those topics that sound complicated, but once it clicks, it genuinely changes how you see every financial decision you make. Let's start with something simple. You deposit $100 into your checking account in your head, and honestly, in most people's head, that $1,000 is yours. It's stored, it's waiting, it's like a lock and the gym. You put your stuff in, you get it back when you want it. That is not what is happening. The moment your $1,000 hits that account, I legally becomes that bank's money. You are become what called in the unsecured creditor of the bank, which is a fancy way of saying the bank owes you $100, but they are now free to whatever they want with the actual physical dollar. And what do they do with it? They lend it out. Here, what most people don't realize, under a system called fractional reserve banking, banks are only required to keep a small fraction of your deposit on hand at any time. Historically, in the US, that reserve requirement was around 10%, meaning for every $100 you deposit, the bank could lend out $900 of it to someone else. But here's where it gets really interesting. In March 2020, the Federal Reserve dropped the reserve requirement to 0%. Zero, that not a conspiracy theory that on the Federal Reserve our website. The official justification was that other regulatory buffer made it unnecessary, but the practical reality is the US bank are no legally required to hold any specific percentage of your deposit in reserve. Now, before you are panic, there are still liquidity rule, capital requirement, and stress tests that prevent bank from just gambling everything overnight. But the core point stand, the system was never what most people picture, and now it even more extreme that it used to be.
Okay, let me show you the math because this is the part that makes people brains shortcut circuit a little. Let's go back to your $1,000 deposit under the old 10% reserve requirement, and banks still operate similarly to the model even without a legal mandate. Here what happened, deposit $1,000, the bank keeps $100 and lend out $900. That $900 get deposit somewhere else. That bank keep $90 and lend out $810. That $810 get deposited, that bank lent out $729, and so on and so on. By the time this chain run its course, your original $1,000 deposit has effectively created up to $1,000, $10,000 in total money circulating in the economy. This is called the money multiplier effect, and it's not theoretical. It's the fundamental engine of the modern banking system. Now you might be thinking, wait, so banks are literally creating money out of thin air? Kind of, yes. The Bank of England, and I am citing them because they published an unusually honest paper about this in 2014, literally started that commercial bank create money whenever they make a loan, not the central bank, not the government. Your local bank, when it's approve a mortgage or a car loan, is creating a new money that did not exist before. Let that sit for a second. Here the thing, the system is not inherently evil. It's actually why economy can grow. If every bank just sat on every dollar deposit, capital would be frozen. Business could not borrow to expand. People could not get mortgage. The economic would stagnate. Fractional reserve banking, in theory, takes idle money and puts it to productive use. The most of the time it works fine, because here the bet the bank is making, not everyone is going to want their money at the same time. Think about it statically. On any given Tuesday, what percentage of depositor and walking into a bank demanding cash? Tiny fraction. The bank knows this. The whole model is built on this predictability, but and this is a big but. When that predictability breaks down, you get something called a bank run, and bank run a catastrophic. Here is a story most people know the shape of but not the detail. 2023 Silicon Valley Bank, the 16th largest bank in the United States, collapsed in 48 hours, not because of some years long fraud, not because of recession, because depositor got nervous. Starting withdrawing money, the depositor saw that and also started withdrawing money, and within 2 days a bank with $200 billion in the assets was functionally dead. SVB and done something that seemed reasonable. They are investing a hug portion and deposit into long-term US Treasury bond. Safe investment, right? Except when interest rate rose rapidly, the value of those bonds dropped, and when people wanted their money back, SVB Bank to sell those bonds at a loss. The math stopped working. The confidence evaporated. The bank was gone. That's the fragility hidden inside the system. Now you might be wondering, if this is how banking works, why does not anyone talk about it? And this is where the psychology gets really fascinating. There's concept in behavior economics called institutional trust by default. Basically, humans are wired to trust systems that are old, large, and socially normalized. Your bank has a building, it has a logo, your parents use it, your employer deposits your paycheck into it at a subconscious level. All of those signals register as a safely, even if you are have never once investigated whether the safety is real. We also experience something called information avoidance. Studies from Carnegie Mellon University found that people deliberately avoid system information that might cause them financial anxiety, even when that information could help them make better decisions. We don't want to know that our bank balance is partially illegal fictional, because know that is comfortable, and the bank benefits enormously from this psychological inertia. The less you question, the more stable their model is. A customer who never think about fractional reserve banking is a better customer from the bank at that than one who does. Look, I am not saying bank are villain. I'm saying the system is designed in a way most of us were never taught to understand, and that lack of understanding costs people money consistently in way I'll explain in a minute.